The tax landscape here in the United States has quietly shifted in a significant way, and many business owners and investors still do not realize just how much the ground beneath them has changed. The One Big Beautiful Bill Act, commonly referred to as OBBBA, did not simply adjust a few deductions or extend a filing deadline. Instead, it introduced a new way long-term tax planning must be approached going forward, particularly for small business owners, real estate investors, and high-income households. In today's video, we are not going to read the legislation or focus on political commentary. Instead, we will walk through what the One Big Beautiful Bill Act actually changes in practical terms, why waiting until 2026 to respond could be costly, and why smart tax planning today looks very different from what it did just a few years ago. Let's begin with the big picture. Why the One Big Beautiful Bill Act matters more than most people expect. For many years, tax planning revolved around uncertainty. Business owners and investors were constantly reminded that important provisions were temporary and could expire at any time. That environment often forced people to either rush decisions or delay planning altogether, depending on which way the political winds were blowing. The One Big Beautiful Bill Act fundamentally changed that dynamic. Some rules are now locked in for the long term, others have been extended with clearer timelines, and the planning horizon has shifted as a result. Here are some of the permanent changes that affect business owners. One of the most meaningful outcomes of the One Big Beautiful Bill Act is the reduction of uncertainty surrounding pass-through business taxation. For years, business owners relied on deductions and rate structures that technically existed temporarily. Even when those provisions were repeatedly extended, there was always concern about whether they would disappear. The One Big Beautiful Bill Act brings many of those elements into a longer-term framework. At first glance, that stability feels reassuring, but it also changes behavior. Business owners who continue operating under assumptions formed in a temporary rule environment may miss opportunities to optimize cash flow, reduce exposure, and plan more confidently. That naturally leads us to another major area impacted by the Act: the SALT deduction shift and why it matters. Another significant change under the One Big Beautiful Bill Act involves state and local tax deductions. For years, the cap severely limited the federal benefit of property taxes and state taxes. The One Big Beautiful Bill Act raised that ceiling for many taxpayers. For real estate investors and business owners in higher property tax environments, this is not a minor adjustment. It affects how property taxes are modeled, how entities are structured, and whether deductions that previously had little federal impact now produce meaningful results. Ignoring this shift often means leaving legitimate planning opportunities on the table. Now, let's talk about timing, because this is where many people misstep. Why acting now matters more than waiting until 2026? One of the most common mistakes we are already seeing is the assumption that there is plenty of time. People hear 2026 and assume planning can wait. In reality, many of the most effective strategies under the One Big Beautiful Bill Act require action well before that date. Income timing, entity changes, retirement contributions, and capital transactions all need to be implemented early to work as intended. By the time tax season arrives, the decisions that matter most are often already locked in. With that in mind, let's shift focus slightly and talk about investors specifically. How One Big Beautiful Bill Act affects investors differently than business owners. Investors feel the impact of the One Big Beautiful Bill Act primarily through capital gains planning, portfolio rebalancing, and the timing of asset sales. Strategies that made sense when future tax rates were uncertain may no longer be optimal. In some cases, recognizing gains earlier or adjusting ownership structure can reduce long-term exposure. In others, holding assets longer may be the better move. The key point is not that everyone should make the same decision. The key point is that doing nothing is now a decision, and often not a favorable one. That brings us to a hidden risk we see frequently: the hidden risk, planning with old assumptions. One of the biggest challenges we encounter is planning based on what used to be true. Many taxpayers, and even some professionals, are still using outdated frameworks. Projections created before these changes often fail to reflect the coordination now required between business, personal, and investment planning. If your projections were built under the old rules, they may already be misaligned with today's reality, which leads directly to an important shift in mindset. Why multi-year planning is no longer optional. The One Big Beautiful Bill Act makes one thing very clear: single-year tax planning is no longer sufficient. Decisions made this year affect deductions, tax brackets, and strategy for years to come. That includes how income is recognized, how assets are acquired or sold, and how retirement and estate planning align with business activity. Tax planning has moved from reactive to architectural. You are building a structure, not patching leaks. Before we wrap up, let's briefly address the mistakes we are already seeing. Common planning mistakes emerging now. Some taxpayers assume expanded deductions automatically apply without adjusting the structure. Others accelerate income or expenses without modeling the long-term impact. Many wait for more guidance instead of acting on what is already clear. These mistakes rarely cause immediate problems. Instead, they surface later, when opportunities have passed and adjustments are limited. So what does good planning look like in this environment? What smart planning looks like under One Big Beautiful Bill Act. Smart planning under the One Big Beautiful Bill Act begins with clarity. It involves reviewing entity structure, understanding how income will flow over the next several years, and aligning deductions with realistic projections. It also requires coordination between business and personal tax planning, rather than treating them as separate efforts. Most importantly, it means starting earlier than many people are accustomed to. The One Big Beautiful Bill Act did not simplify taxes. It changed the rules of engagement. Business owners and investors who adapt early can use this new framework to their advantage. Those who wait risk building plans on assumptions that no longer apply. If you have not revisited your tax strategy since these changes, now is the time. At GavTax Advisory Services, we help clients translate complex tax law into practical, forward-looking strategies that support growth, protect cash flow, and reduce surprises. If you would like a personalized explanation of how the One Big Beautiful Bill Act affects your situation heading into 2026, visit gavtax.com and schedule a consultation. Thank you for watching. I'll see you in the next video.